Alright guys, welcome to part 2 of the principles of technical indicators. Again, a little bit of disclaimer before we move on. Alright, indicators can be classified into 3 types as well. It can be classified into trend indicators, momentum indicators, and also volatility indicators. Now let's go through one by one. The first one is trend indicators. So basically, what is a trend? A trend is a movement of price in one direction for a long period of time, and if you're a beginner, it is recommended that you trade along with the trend. So only when you become more experienced, then you should trade against the trend, because that requires a lot more skills to pick tops and bottoms. And also, the thing is that when you're buying a bullish trend, the probability of the price going up is higher than the probability of the price going lower. So if you are selling in a bullish trend, you are literally trading against the tide. And it's also very crucial for traders to learn to spot a trend. Not only learn to spot a trend, but also determine whether the trend is strong or not. Because there are some trends, they are really strong. Some trends, they are more weak than other trends. And you also need to understand, are you trading at the start of the trend, middle of the trend, and end of the trend? So it's also very important for you to determine which stage of the trend you are trading at right now. So we are all visual people. So what is a trend? Basically, this is a bearish trend. So when it comes to a bearish trend, visually you can see there are lower highs. Okay, lower highs as well as lower lows. So when it comes to a trend, you realize that there are longer term trends and also shorter term trends. So for example, from here until here, this is a long-term trend. Some people call it a macro trend. Okay, and then from here until here is another trend, but this one's a shorter term trend. So you see that in the larger term trend, there are many micro trends. Micro trends both going upwards and also going downwards. So this is why if you are to ask a day trader what is the trend now, they might tell you that right now is a bullish trend. But if you are to ask a position trader what is the trend now, they would say that, oh, right now it's a bearish trend. So are they both correct, or are they both conflicting each other? Actually, both of them are correct, because when a day trader looks at a smaller time frame, they'll see a bullish trend. When a position trader look at a larger time frame, they'll see a bearish trend. So they are telling you the answer based on what they see, based on your time frame. So when you see a trend like this going downwards, a macro trend like this going downwards, you will want to look for a sell. Okay, then of course if you see a bullish trend, then you want to look for a buy. Understand what I'm saying? Like I said, if you are a beginner, try not to buy the retracements over here. Okay, try not to buy this retracement. Try not to buy this retracement, because even if it retraces, it's not very significant. So it's better for you to sell and then ride the whole entire wave. Okay, so the first type of indicator, I want to go into detail. What are trend indicators? Basically, trend indicators, it allows you to determine the formation and the strength of the trend. Helps you identify a trend and also helps you determine the strength of the trend. Is the bullish trend weak, or is it very strong? Number 2, examples of trend indicators, you have simple moving average, exponential moving average, force index, parabolic SIR, ADX, and also trend lines. So the easy way for you to spot a trend is of course visually. When you see higher highs being formed, and then higher lows being formed, okay, then this is a bullish trend. You see that in a bullish trend, a macro bullish trend, you see micro trends, micro retracements. Alright, so you don't want to sell into all these. What you want to do is to look for a buy trade. Understand what I'm saying? So a simple way to determine what the trend is right now is by visual inspection. Just look at whether there's high highs, high lows, and the second way to do that is by using moving averages. So you can see that I have 3 lines over here. Again, I'm going to go into detail all these moving averages one by one in the next few lessons, but for now just understand that the yellow line, this one is a 50 SMA, white line 100 SMA, blue line 200 SMA. Okay, so in the bullish trend you see the 50 being above the 100, 100 being above 200. This would tell that okay, the bullish trend is going on and it is overall pretty strong. Okay, just understand this for now. I'm going to go into detail in the next few lessons. So the next type of indicator is volatility indicators. Volatility indicators indicates a change in price, and it allows you to determine the volatility of the markets. Example of volatility indicators, you have your ATR and the Bollinger Bands. Okay, so some people use ATR to set their stop loss. Some people use Bollinger Bands to set their stop loss. Some people use it to trade breakouts. Some people use it to take profit. So different people use it differently. This is an example of Bollinger Bands. Okay, so you realize that the more volatile the candles are, the markets are, the wider would the bands become. So if the markets are going sideways like this, going sideways, and the candles are really small and markets are not that volatile, you see that the bands will start to narrow. It will narrow down, right? And as the candles start getting bigger, you realize that the bands will start expanding. Alright, so hence a lot of traders, they use this as a volatility indicator. So the third type of indicator is the momentum indicator. What it does is that it measures the velocity of the movement in price, okay, in both directions, both upwards and downwards, and it allows you to determine the market momentum and strength, and it provides you with potential reversal signals using divergence. Example, you have RSI, stochastics, MACD, rate of change, and some people use Chaikin money flow. So basically, let's pick one indicator, RSI, and this is basically how it looks like. So you realize that there are two extreme levels. This one is the overbought level, and this one is the oversold levels. Alright, so basically how you use momentum indicators is that you want to wait for a signal when it goes to the overbought, okay, these 3 points over here, or oversold level. When it is somewhere in between here, you don't want to look for any trading signals because the probability of the trade working out will be less. So when it comes to picking momentum indicators, you need to pick one of them to confirm your price action. Okay, so you cannot use price action alone. You need to use a confirmation indicator, and one of which is a momentum indicator. At most you can pick two, but I don't see the point in that because they normally give you the same signals. Now the thing is, when it comes to momentum indicators, when it is overbought, it tells you that the markets might go down. When it is oversold, it tells you that the market might go up. But it depends on the context, okay? Because in a bullish market, markets tend to be overbought a lot. So when you see a bullish trend and you see overbought signals, don't use that as a sell signal. Understand what I'm saying? When the markets go to overbought in a bullish trend, it just tells you that there is strength in a bullish trend. There is still bullish momentum. So same thing when you see an oversold signal in a bear market. It just confirms that there's still bearish strength. Okay, that's it. It's not a buy signal. So I'll talk more about this during the next few lessons when I go into detail. But basically, when it comes to momentum indicators, you can use it for all time frames. But I would prefer still the higher time frames. I don't really like the minute time frames because there's a lot of noise and hence a lot of false signals. Even though momentum indicators indicate to you that the price is going to reverse, but the thing is, it won't tell you how far the price would reverse. Understand what I'm saying? So that's why you need a lot more confirmation indicators for you to determine, okay, whether the price is really going to reverse until this point or not. Basically, you cannot use momentum indicators alone for you to generate buy and sell signals alone. You need to confirm it using other indicators, you need to confirm it with the market context. You need to confirm it with price action. Okay, so how do you use momentum indicators? Like I said, when it goes to overbought, you can use it to take profit, you can use it to sell, or you can use it to scale out, meaning reduce your risk exposure. So basically, when can you open a sell trade? When the momentum indicator goes to overbought level, and that is during a bearish trend. Okay, because it is during a bearish trend, then you should look for overbought signals. Basically, in a bearish trend, look for overbought signals, and then in a bullish trend, look only for oversold signals. Okay, to look for a buy. Understand what I'm saying? If you are not clear about it, write it down. Write it down. Bearish, you look for overbought. Okay, bullish trend, you look for oversold. Okay, so I just want to point out to you that when the momentum indicators go to the extreme levels, either overbought or oversold, it doesn't guarantee that a reversal is going to happen. It just increases the chances that a reversal is going to happen. So that's why you can use it as a take profit signal, or you can use it to scale out. Because the thing is, when the price goes to overbought, very likely you see a massive uptrend, and a lot of traders, they get caught up in the emotions, because when people see rising prices like a lot of green candles, they would have this tendency to want to buy more. But if you have this momentum indicator in place, you would take caution, you would be careful about that. So some of the momentum indicator principles you need to take note of. Number one, larger time frame increases the significance. So for example, if you see an overbought pattern in a monthly time frame as compared to an hourly time frame, which one do you think is more significant? The chance of reversal after the overbought signal would be higher in the monthly time frame as compared to the hourly time frame. Basically, the higher the time frame, the higher the chance that the signal is going to work out. And the second thing is, like I said, it's not 100% fail proof. Sometimes it might give you bad signals, sometimes it might give you false signals. So that's why you need to confirm it with price action. But if momentum indicator gives you a signal, but then price action doesn't give you a signal, then do nothing. It's better to do nothing. You want a price action to give you a signal, and at the same time, momentum indicator also give you a signal, then it is a high probability trade. Okay, and then the third thing, reversals might not be immediate after a signal is formed. So sometimes when you see a reversal pattern, or if there's a signal from momentum indicators like a divergence, the price would kind of go sideways before it reverses. So it wouldn't reverse immediately. So just take note of that. Okay, so with that, I hope that this lesson gives you a good idea on how to use indicators and what are different types of indicators, and I'll talk to you more in the next few lessons.